IRA rollover rules. Hey everyone, Adam Bergman, tax attorney and founder of IRA Financial. Welcome to another episode of AdBits. On today's podcast, I'm going to explain in detail everything you need to know about the SEP IRA rollover rules. And pretty simple, actually. The reason I wanted to do today's podcast is I had a lot of clients that are looking to move funds into a solo K. They're like, Adam, I want to set up a solo K. I know you could put away $69,000 or $76,500 if you're over 50. It's a great plan. I can borrow $50,000 or 50% of my account value, whatever's less. I have checkbook control. I'm the trustee. I can do traditional assets, alternative assets. I can even maximize using leverage with a 401k for real estate and not trigger this UBIT tax. It's a no-brainer, but I don't have enough money to put in it, Adam. I believe that you can't roll over IRA or SEP IRA funds into a solo. So what do I do? Well, this podcast is here to correct all the inaccuracies and let you know that, yes, you can roll over a traditional IRA, a SEP IRA, a simple IRA into a 401k, okay? The only thing you cannot roll into a 401k is a Roth IRA. The only thing you cannot roll into a SEP IRA is a Roth IRA. Everything else can be rolled into or out of a SEP IRA. Traditional IRA, SEP into a SEP, simple into a SEP, 401k into a SEP. Now, the only thing to remember is one, Roth IRAs cannot go back in time. You can't be put in or rolled into a pre-tax IRA or 401k. And number two, if you are employed and you're under the age of 59 and a half, you don't have a triggering event. Therefore, you cannot roll 401k funds into a SEP IRA or a traditional IRA, or actually into any other 401k. You need a planned triggering event if you're a current employer. Now, if you leave your job, you're over the age of 59 and a half, or the company terminates the plan, then you do have a triggering event, and then therefore you will be able to move those funds into a 401k or into another 401k or into a SEP IRA or a traditional IRA tax-free. If you wanted to get the pre-tax funds into a Roth, you would have to pay a tax on the value of the cash or the assets you're rolling in. Okay, so this is a pretty simple podcast. SEP IRA, it's a great type of retirement plan. It's a profit-sharing plan. In 2024, you can put away $69,000. There's no catch-up if you're over 50. You can now do pre-tax or Roth. It's an employer contribution, so there's not actual employee deferrals, like if you worked at Apple or IRA Financial, and you could put away, if you're under 50, 23K, or if you're over 50, 30,500. In a profit-sharing plan, i.e. a SEP, it's a percentage. So if it's a single member LLC, sole proprietor, it's 20% of your net Schedule C. And if you're W-2, it's 25% of your W-2, up to a max of 69K. So if you make 100K and you're sole proprietor, you can put away 20. Okay, if you are a W-2, make 100, you can put away 25. If you make 200, you can put away 40 if you're self-employed, 20% or 25% of 200. If you make $1 million, you obviously are capped at the 69. For 2023, you can still set up a SEP up until the company files its return, March 15th, April 15th, plus extension. So SEP's a great plan. It's just a 401k. The solo case specifically is better because you can put away more money, right? A simple example, 100K, under 50 years old, sole proprietor, 20K to SEP. A solo K, you can do 23 plus 20, right? $23,000 for dollar plus 20% is 43 versus 23, versus 20. If you're over 50, making 100K, you'd be able to do 30,500 plus 20 or 50,500 in a solo K. A SEP, only 20. So, over 2.5 times. So that's why, plus the loan feature, plus the ability to maximize using leverage with real estate, a bit better asset and credit protection. In both cases, you can checkbook control. So that's not really an option or an issue. And then before 23, you couldn't do Roth in the SEP, and now you could. So that's not an issue either. So just something to keep in mind. But from a rollover perspective, anything go into a SEP except two things: Roth IRA, or if you are currently employed under the age of 59 and a half, your current employer 401k cannot be rolled into a SEP. It actually has to stay in the plan because you do not have a triggering event. That's it. Short and sweet. That's what we do at AdBits. Just a bit of info on very specific self-directed retirement topics. Hope you guys enjoyed the podcast. If you did, please leave a good review, rate it. If you're watching on YouTube, definitely subscribe if you haven't already. If you are a subscriber, thank you. Just give it a thumbs up. That's always appreciative. That's it. Have a great rest of your day, and I look forward to seeing everyone again, all you guys, on the next AdBits. Thanks, and take care.